Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, you're active, passive, or you're just interested in the idea, or maybe you've been working in the industry for a long time, well, good news was you're in the right spot. We designed the Gray Report just for you to get you the most up-to-date and important information to help you make some really smart investing decisions. We've got a great list of reports put together by Matt Bosnagel from Bureau of Labor Statistics, Washington Post, the Journal, Yardi Matrix, and RealPage. A lot to get into. We're just getting into the beginning of the year 2023, so we've got to make some really good decisions. And let's do it on the Gray Report. All right, let's get into it. All right, everyone, welcome back to the Gray Report, joined, as always, by Matt Bosnagel.
Good to have you back.
Hey, thanks, Matt. It's good to be back in the saddle. We were able to make last week's episode work.
Yeah.
But a little bit different background. I don't know if you can see the background in the last video or not.
It doesn't look like an ocean behind you today.
No,
so
it was sad. It was pretty awesome. But I'm a little jet lagged, getting off a fun time with the FAA outage last night. It was a lot of fun. Traveling with three.
I overheard what you said. If your plane left 30 minutes earlier, then you would have.
I think so. Yeah, it was like mechanical failure. We were taking a red eye back from from Hawaii to San Francisco to Indy, and then we were getting on a red eye at 11 p.m. Mechanical failure. We could have taken off, but then once they got the mechanical failure figured out, which I'm glad they did. It was going to fly in a 737 MAX. It was going to be the first time doing that.
Yeah.
With all the issues they've had. And I was like, mechanical failure, great. And then they're like, there's a ground delay. And then 3 hours later on the tarmac, it was canceled. And
was it Southwest?
No, it was United.
Okay.
So
just wondering, because that's Southwest.
I think Southwest. They were like, see, everyone's got computer problems.
Exactly.
That could happen to everyone. The FAA. So anyway, we talked about real estate because I think this is going to be a good year for real estate, Matt.
Yeah, a lot of things, like a lot of the articles that I've read and the research that I got this week is really kind of taking stock of where we're at. Mm-hmm. And I think some of it's really interesting. Some stuff is like realistic and is going to showcase some tough spots, especially some specific markets. But these are problems that are solvable. And I think that investors could really make some good decisions this year.
Yeah. Well, I think so too. And it's always hard to determine, are we looking in the rearview mirror? Are we looking forward? Where are we? Because a lot of the concerns that folks have in the rental market have really already kind of happened in terms of, rent declines, cap rate expansion. A lot of that stuff has already, been happening for the last 2 quarters.
That's actually really interesting that you say that, because like I was thinking of this past year of the 2022 as this like transition year. Like the start of the year was so much different than the end of the year, whether it's inflation or rental price growth. But this year is like the real effects of multiple intersecting shifts that were kind of ongoing in 2022. Yeah. They actually in the Yardi report, they talk about that 2023 is like going to be a year of transition and stuff. I think it's a year where we'll finally get a settling of the transitions that begun in 2022.
Yeah, I think so. And a little bit back to kind of a little steadier of pace. And I can't help but think so much of this is, really just related to the money supply in the Federal Reserve. And, it's like, how surprised are we that, we pumped a bunch of money into the system and things were growing and it was crazy. And now we've taken a bunch of money out of the system and things are retracting. It kind of makes sense. And as the Federal Reserve kind of stabilizes, and I hate to think there's just, one entity that has so much control over the economy. And it's still hard for me to like connect the dots from, buying more or less mortgage-backed securities and moving interest rates up or down to someone making the decision not to look for an apartment or to stay and live with their parents. But at the same time, the Federal Reserve takes these actions to make that type of demand destruction happen. And I think we've
collectively,
collectively. It has to be individual decisions, but collective action. And I think we've seen that take place. Yeah. And then so if we say, okay, we've been in this period of retraction for going on 6 months or so. Are we 6 months into a 12-month phenomenon, which means the latter half of 23 is going to be really exciting?
Yeah.
Or is it an 18-month thing, and then it's just, it's going to be Q4 2023 that where things are going to start picking up?
That's what I was thinking when I was reading the CPI report, and I think that collectively, I was like, I'm such an able. Like, everyone is going to realize, oh, we were in a recession all along.
Yeah.
Or like,
something like
we
it.
didn't even know what we were dealing with back then. We thought we had it good or bad, or like, we're in the middle of something that needs perspective. And I think that we still were in 2022, like the first half of this. And then maybe 6 months from now, we'll be able to look back and say, okay, this was tumultuous, but now we kind of have at the end of the cycle. But what Yardi Matrix is saying is like there are multiple planes or like multiple vectors of transition that are happening at the same time, and I think that that's what's made this really really unpredictable. We don't know. Yeah, it's gonna land. The plane's gonna land, but we don't know where. And so hopefully it's a runway.
But then I guess is the plane to continue the hard landing, soft landing, plane landing.
I'm looking for a runway.
We're still like things keep moving. So it's like we're always still going to oscillate. So how rough is it going to feel, and how much pain is there going to be? And I also think it depends on where you are, in the economy, whether you're someone working in the tech sector, or if you're a kind of blue collar, lower in the lower wage sector, or you're working in real estate. But even in real estate, if you're a realtor selling single family homes, it feels a lot different than someone working in the multifamily industry, even though there's challenges in both. They're just different. Yeah.
And I think that the CPI, this recent CPI print is kind of a sign that it may not be all doom and gloom. And I think if I had to say like what I think is the prevailing feeling is that maybe there's a lot more hope for a soft landing than there was a couple months ago. Yeah. And like I would be the last to say that because I don't like to really categorize the dominant feeling of an economy, but it definitely feels like a lot. Whether or not let's say most people are still thinking that it's going to be a hard landing, but that number was a lot bigger 2 months ago.
Well, it went from being they're shooting for a soft landing to soft landing is no longer possible.
Exactly. Yes.
To, well, it is possible.
Yeah.
So we shouldn't rush to say things are impossible quickly, I think, or so inevitable. Yeah. A recession is so inevitable in 2023. It's good. Yeah, certainly good. Or are we going to look back to your point, Matt, and say like, okay, well, maybe this didn't meet the technical definition of a recession because unemployment still was strong, but there were, more kind of secular retractions in different sectors in different parts of the economy. That just, again, like the whole table just got like thrown up and the pieces are all in the air. And, they're
all the stock market losses of 2022 and like, and a lot of companies are still feeling a lot of pain. Something bad happened.
Yeah. Now, but the REITs are rallying, man, on this CPI report.
Oh, good. Well, that's good to know.
A lot of people are getting very hopeful for real estate, just thinking that, all right, maybe interest rates aren't going to continue to go up too much. That's going to kind of let things plateau and sit for a while and let the real estate market kind of think.
Well, and you can't argue with, and if we just want to get into the CPI, you really can't argue with the fact that CPI is negative. It was a negative 0.1% last month, not just lower growth. It's not because, you'll see a lot of headlines like last month we saw headlines or whatever, the last CPI report, we saw headlines of a cool down, but really it was slower growth. Yeah. This is actually negative growth. So I think that that's meaningful. And one indication is, and you said this again, it's like you can't blame one person for the economy. A lot of people critiques of the Biden administration will try to have been using inflation as an argument. Yeah. I don't think anyone really is responsible for the wins or losses, any one person other than Powell. But I did listen to this morning. I listened to a news report about the price of eggs. Yeah. And like if they've got to get to egg prices, then maybe inflation's doing a little better than you think.
Yeah. If eggs are what we're holding on to, eggs aren't nearly as important as gasoline or other food items. I mean, it can't be helpful. But I mean, just looking at food, I mean, what was even food here? Let me go to the
food's pretty. If I remember correctly, food is still up.
Yeah, it's
significantly.
It is up. It's up 0.3 compared to November through December. But it's much better than September to October. I mean, it's half.
Yeah.
From
I will say, like, it does feel like I'm spending a lot more on groceries now. Yeah. And that's the quintessential experience of inflation is what's your grocery bill? And that's actually, it's almost like concentrated there. There's a lot of other aspects, but food's up a lot. You know what is still up, and it frustrates me, is rental inflation. So year-over-year inflation.
Are we moving off the egg conversation?
Oh, sorry.
No, I'm kidding. Yeah. But yeah, I mean, look at that, though. I mean, that's 11. That's a lot.
11% more in just 1 month.
Okay.
And year-over-year, 59% higher than it was last year.
Wow. What are people doing with these eggs? Is there a we talked about this, man. We don't know if we looked it up. Is there some kind of, like, do they have to do a mass killing of chickens?
I thought that was the reason that I heard from the news report was avian flu.
Avian flu.
Now, I think that
poultry.
No, while you're pulling that up,
as we digress.
So yeah, the year over year for all items, maybe I need to check core items, but that's at 6.5, and so it is less than it was than the year over year was last month, and again, I'll return to let's get some of this information on these.
Well, now it's giving us an ad, but I mean it's according to Acadiana's KATC3 ABC, experts say bird flu is impacting egg price.
I was thinking about this. You can point to discrete things, and that was what the argument against inflation was. It's like, it's just no. It's not inflation. It's hard to ship. Metal is really expensive. It's this. It's that. But it's all collective.
Yeah, it is all collective. But this is one of those. And we have to separate the actual transient, short-term inflationary pressures, which would be like the supply chain stuff, to the longer running pressures of inflation or deflation, whether that's like onshoring or like the nearshoring of jobs and manufacturing. That's inflationary over time. Like an aging population and technological advance, that's deflationary over time. And there's going to be some short-term spikes, and that are going to cause inflation and prices to go up. But we can breed more chickens.
Yeah, that's true. It's not like it's not like demand has increased so much and we just can't make any more eggs. Yeah. It's like, no, we had to
kill a bunch of birds. Yeah. But I mean, like lumber. I mean, lumber is still expensive, but it's not like it was in the middle of 2020.
Yeah, it is like half. I remember lumber was almost like 1,000.
Yeah.
For whatever its unit price that we track, and now it's down to like 300, 400.
Yeah, which is still elevated compared to before COVID, but like it's come back down.
Yeah. So it is interesting, to look at all these different things, and to your point, to separate what price increase is the result of a larger trend that we should be worrying about, and what's something that's fixable.
Yeah, a little more flash in the pan, and okay.
So going to rent, I think that this is one of the more frustrating results that I got from this rent report. Rental inflation is still paradoxically high. This past December, rental housing was up 0.8% month over month and was up 7.6% year over year. Now, I want to give a little bit of a context and call back to an article that we covered last month from the Cleveland Fed.
Yeah.
It constructed an alternative measure of the changing price of housing rentals, and pretty much the distinction that they made, which is not a new one at all, is that the CPI measures rent growth that hits people's pocketbooks, so it's what their experience of inflation is, and the private rent metrics like we get from Apartment List or Zillow has one, or Yardi Matrix. Those are all the decisions that are being made in the marketplace. So it's a different ways of thinking, but like. Another point that I learned kind of in the Cleveland Fed article was that was that the CPI does do work. They actively are trying to adjust their measurement of rent so that it is helpful for people, so people can use it. But their goal is, I think, on an accurate picture of the pocketbook thing, the pocketbook part, not the marketplace part. And the Cleveland Fed, it's part of the Federal Reserve System. Yeah. So obviously someone in the Fed is worried about this, or at least thinking about it. And I think that
so that they can properly discount it.
Yeah, well, I don't know.
Because there's no rule.
That's a good
there's
point.
no
That's
rule that says they're like,
so good.
Well, CPI said, rent.
We made this report.
Shelter. We can't.
We made this report in Cleveland, so we're just going to keep things the same. I think that they're keeping it the same because they want that accurate picture of people's pocketbooks. I would love an alternative measure just to be included with like asterisks next to it if you want to see what the market price is.
You should go into the beige book and read the minutes, see if they're talking about it.
Oh yeah, that's a good idea. And the other thing that the Cleveland Fed...
Now you're like, you want me to go through that?
I know. Well, okay. All right.
Load it into ChatGPT.
Some of the stuff in the beige book is really interesting, little tidbits.
Yeah.
The other point that the Cleveland Fed made was that the CPI rent measurement pretty much lags these new market rents by 12 months, maybe 13. I'm pretty sure they said 4 quarters.
About a year.
And that's what's frustrating is like, I'm looking to see when the rent deceleration is going to pop up in the CPI. We may have 6 more months of this.
If it's, I was going to say, if it's 12-month lagging.
Yeah. So it maybe this month was 0.8. Maybe we'll start to go down. I don't know where the trajectory is, but I bet it'll
start to go down in just a couple months, in 3 months, around March.
Yeah.
March and April. That's when things started, I think, changing a little bit.
Yeah, that makes a lot of sense. And so with that in mind, we're going to see a lot lower CPI. Right now, the CPI is like kind of artificially high, and I forget how much percentage that it accounts for, but it is a significant amount.
For housing, it's it's 32.9. Yeah, 32.9 for shelter.
So so it's a big chunk, and that's going to really have a positive effect on the inflation situation.
So maybe 25 basis point increases the next meeting or two, and then they're gonna plateau and go flat.
I hope that they just let's just not do anything.
Yeah.
It's easier. You don't have to flick the 25% increase button. There are articles that have already been written that said, hey, maybe we just stop it. Maybe we already did too much, and it's already gone up too much, and we should just coast now. We're good.
I think there's definitely a lot of people who think that and want that to happen. I think there's a good case to be made. I believe, though, the Federal Reserve they see a much greater degree of risk of misreading and giving into the market and lowering rates or just not raising rates too soon. Mm-hmm. And because for 2 reasons. One, if inflation does persist, they'll have gotten it wrong again. Mm-hmm. And 2 is it's a credibility thing. They don't want to be seen as, kowtowing to the market, just because the stock market wants, rates to go down and other markets want the rates to go down, doesn't mean they can give into it. And they have to have some, legitimacy and see it through and be persistent. And I think that, in the minutes from the last meeting, I mean, they were very clear that, if we see a rally in the stock market, that's not necessarily going to be, we'll see that as a reason to keep rates higher. Mm-hmm. And we don't care about where the S&P 500 is right now. We're looking at, stable prices and employment, and, employment's doing well. So we really need to focus on stable prices. Yeah. And we've got some room to hit the stock market and the rest of the economy, because looking at employment, we know we're in a good spot. Yeah,
it's going to be, again, we're on the halfway point of a lot of these cycles, and one of them may be the interest rate cycle.
Yeah.
This is going to be an exciting first quarter.
Yeah.
That'll really actually, I guess it's a hope, but, we're going to set the stage here. Things may be uncertain for a limited but finite period.
Yeah.
And after which we may have a window where we can make some predictions.
I think so. And just to throw an early prediction, could not be the case, but I think there's a possibility that, we do get rates to level off and we see demand coming back. So I know we've got a couple other articles, I think today, that talks about it, just like the potential pent-up demand because people have been putting off this decision to rent or to get a house or whatever it is, and that demand is going to be released at some point.
Yeah, I think so, because it works both ways.
It works both ways. Yeah. And so I think we're going to get on the other side of that. Again, maybe it's March, maybe it's September. But I think sometime this year we're going to see a market that looks pretty attractive. And then the key is there an entry point before that? And once we're in that point of kind of stability, normalcy, able to predict, things are looking good, everyone's going to be piling in at that point. And so is there a safe way to get in kind of before the frenzy starts again? Because I can just tell you from talking to people who are in the multifamily industry, people are still looking for deals. Yeah. It's not like people are like leaving the market. Yeah. It's just that good deals are hard to find right now.
This is going to be, I think that there are these high flying, and we can kind of get into some of this in a little bit, but some of the continued strong performance of a lot of these multifamily markets that you'd think would be joining the rest of the nation and sinking down. It's almost like there's signs like maybe we don't have it as bad as maybe the rental situation isn't as bad, and the proof is that like some of these high flyers are still flying pretty high.
Yeah. Good point. Well, before maybe we get into like the macro details, Matt, there's an article from the Washington Post that doesn't paint as rosy a picture as we were just discussing.
Yeah. So
rental housing is suddenly headed towards a hard landing.
To give credit where credit's due, I found this through Jay Parsons' LinkedIn post about it, and I'll include his commentary.
Well, I was going to say he was featured. He was featured in the article.
Oh yeah, so okay, they quoted him, so he gets to talk about it on LinkedIn, and he did have a response that we'll cover that I summarized here in a little bit too.
Perfect.
So the article points to, I think, what is actually a really interesting framework and context for understanding recent trends in the apartment market. It feels like we've looked back to 2008 a million times since the start of the pandemic. Hoping like for a lesson from the Great Recession that can guide us through, whether it's the pandemic or now or whatever. We're always looking back there. And a lot of times they've actually provided a favorable understanding of our current moment from the perspective of like apartment investment. Even in the lowest points of the pandemic, the housing market was never. So some of these differences were that even at the lowest points of the pandemic, the housing market was never as hopeless as it was in the late 2000s. So it was always nice to look back to that time and be like, well, we don't have as bad. That's one reason why it was nice. Another was that we were and are assured that like the financial tools and like the financial shenanigans that preceded the 2008 crisis are not as much of a factor today, whether it's through like disinterest or like hard regulation. Like they don't want to take on that risk. And then there's the story. This is what I want to get into a little bit more of the 2008 housing market crash and its protracted decade-long impact on what kind of housing they built during it, and a little bit about what they were doing beforehand. And so I'll kind of explain. Connerson points out a particularly relevant aspect of the great financial crisis or housing crisis, whatever. Single-family homes took a huge hit, but apartments didn't take as big of a hit. Apartment performance definitely impacted, but it was outside of like 3 months in the middle of 2010, where it was just barely negative. Year-over-year rent growth was consistently positive after the great financial crisis. And I have actually like the little rent growth charts that you can pull up if you want.
Yeah, because I thought that there was at least like a year of negative rent growth.
So that's rent of primary residence for the U.S. national average, and you can kind of see how it dips into the negative right around 2010.
Yeah. And but this is from CPI.
Yeah, that's a CPI, and we just talked about CPI.
Yeah, well, exactly. I think it's kind of like a year. Like
it smoothed it over.
It smoothed it over. I think we looked at some of those market rate. Numbers, there was like a full year of negative rent growth.
But if you're factoring in renewal, what makes CPI lag is that it factors in renewals as well, and we're going to talk about this later. But general overall, if you ask the average person, they would not have had a long period where they weren't paying a little bit more than they were last year in rent. So that's one story about the financial crisis. Home prices went down. Rents didn't crash like that.
Yeah, no, the issue wasn't necessarily rents or even demand for housing. It was financial and liquidity. crisis that, obviously created economic uncertainty, and people had to raise the rents, and people were laid off. And so, there was a lot of unemployment, and
so
it wasn't good. So
that's how you understand it.
That's how I understand it.
But Connor Sens, that's really funny. I was like, oh, well, this is what he would say. Yeah. He said that leading up to the 2008 recession, the industry was focused on building single-family homes a whole lot more than multifamily. And so homeowners who lost their homes, they had an undersupply, and they couldn't live in there, and so they went into rent apartments. Because after the great financial crisis, home builders were not building as many as many homes. So he says homeowners lost their homes, and after 2008 had to live somewhere. They rented apartments, and then the entry into the workforce of millions of young members of the millennial generation was better off for rental ownership demand at the time. So whereas home builders who are nationally focused became more conservative in the 2010s, multifamily developers who are more local and regional were intent on building as many apartments as they could to meet the demand from young millennials. So there's kind of two trends. That's what I was trying to note before: the underbuilding of apartments pre-Great Recession, and the overbuilding after the Great Recession. And I looked at this. Essentially, what happened was single-family completions went from a low of 400,000 all the way up to a high of 950,000. So the low in 2011, the high 2018. Whereas multifamily completions went from a low of 103,000 to a high of 400,000. Essentially, what do we have? Like a little more than doubling of single family, a little more than tripling, maybe even quadrupling of multifamily completions.
But we didn't get up to 400,000 until 2019 or so.
Yeah, both of these are around 2018, 2019 completion numbers is where the high points of both of them are. And I think we may have noted this before. I forget if we were talking during the show or not, but a rising tide lifts all boats. Housing is rental housing is connected to demand for single family home housing in a lot more closely than people suspect.
Well, it's kind of surprising because you would assume that one would cannibalize the other, and we really learned this, or really was cemented as this is an actual real thing back in during COVID, during 2020, that when interest rates were so low and everyone was buying single family homes, you would think that, who would be renting right now because everyone's flocking to buy a house. But they were buying houses, but we also saw a rental demand spike as well. And now that the single family home market has cooled, you would think that people will still be renting apartments, and they are, but the rental market has cooled as well. So
they're a little more closely. I think that it almost seems like there's been wider swings in single family completions. In multifamily completions, I wouldn't read into its relative recovery, because if you look at single family completions before the great financial crisis, it is insanity. It's like 1.5 million every year, and that's pre the housing crisis. In the 20-year span from 1995 to 2008, home builders constructed more than 1 million units every year at least.
And not too dissimilarly than today, that they were in relatively concentrated markets also.
Yeah.
They're in South Florida and Phoenix and places like that.
So just to run through Jay Parsons' response on LinkedIn, he did notice that rents perform better after downturns because they recover more quickly. It shouldn't be held against apartments. And shouldn't mean maybe that apartments would do poorly today. It just means that they're structurally better able to recover. It's a lower payment that you got to make than it is to just go ahead and buy a home, which is additional barriers are created. It's a slower market.
Yeah.
He also noted that the demographic situation, which Connor said, and this is something that I think is maybe compelling about Connor about his article, is millennials were apartment buyers. Their peak apartment buying years were during the Great Recession.
Home buying years.
And now we're in home buying years for millennials.
Yeah.
And
peak
so
renting,
I'm wondering what that is. I think that, and you said this before the show, is this environment going to be changed? Are millennials going to, unlike other previous generations, be less interested or less able to buy a home? And that could really support continued apartment demand.
And I think it's one of those things it's probably going to be on the margins. It's not going to be like all millennials decided they don't want to live in a house or buy a house, but there's going to be some, but some aren't going to be able to afford to just just as a fact, they may be living in a market that's too expensive. They're not making enough money. The homes are too expensive. And then it's going to be a preference thing. People are going to like apartments. I also think this is where build to rent comes into play, and it really kind of provides that balance. Because typically, you want to buy a house not because you want to, you want to own a home. Some people do. It's like, I just want to own my own home. But a lot of it's, they want the space because they're starting families and they're settling down and they want the room.
Yeah.
They've got a dog or whatever it is. It's more of those factors rather than I just want to own something.
Yeah, that's a good point. And Jay Parsons made a similar point that we were talking about before, is like, really, demographic issues aside, rental price growth is correlated with single family home price growth. You really need to look at housing demand collectively because they all tend to move in the same place. There's never been, and it's true too. We were expecting, all of these people turned off by home buying. They're going to flood in the apartment. Single family homes are too expensive. Now they're going to go into rentals, and rental demand's going to be huge. Yeah. That didn't happen.
It's almost like maybe a good analogy is like car buying. It's like, because buying versus leasing a car. It's like, it doesn't matter. At the end of the day, really it's like point. Demand for cars, demand for a place to live, demand for a house, demand for a house, demand for vehicle. Whether you're leasing or you're buying, you're renting, or you're getting a mortgage, you need the car. How you're financing it essentially is what we're talking about.
Yeah.
That's kind of in the details.
Yeah. And then, carpooling or not.
Exactly. I'm not buying a car, I'm carpooling.
Yeah.
I'm moving in with folks. No, good point, Matt. All right. Anything else on this Washington Journal report? You want to move to Wall Street?
Yeah. So the Washington Post, and this was actually originally posted in Bloomberg, but you can find it more easily in the Washington Post. The Wall Street Journal article is actually really interesting because it is a topic that really, as much as it's overcovered almost, and it's like a topic that people like to talk about. It's this office investors and and they're looking for alternatives.
Yeah.
Basically, the headline is top office owners don't want to own only office buildings. Yes, it's a cliche to talk about empty office spaces and the remote work. What did I say? I had a really good. The transformative death and rebirth of American working culture. Here's one. What did I say? The remote working revolution with a shadow that looms large over the office space. So we've heard that, and it was fun for me to make up these cliches.
Yeah.
But I do think that it is something that is going to continue to reverberate. It's going to kind of change culture and change the real estate market for a longer time to come, and more powerfully maybe than people are than a cliche can accurately convey.
I mean, how many people are, even though the offices that are in demand are the brand new offices, the Class A with like the amenities, but who's getting in line to develop a brand new, high-rise office tower? Yeah,
I think there is a trend, and it is observable. People are moving a little bit back to downtowns, a little bit away from suburbia, because companies are getting a little bit more moved back to the office-y, if I can use the right phrase.
Yeah. All right, it's 2023.
There's going to be things that still persist. It's notable that the headline, what was it? I think it was Disney. Bob Iger wanted people to come back to the office 4 days a week. Now, back in my day, 5 days was the office days. Yeah. But it's notable that is being read as like, they're coming back 4 days a week.
Yeah. It's still 4 day work week. There's a lot of proponents of the 4 day work week.
Yeah.
Do you have any thoughts?
1 day less. Why not a 6 day work week?
Why not?
Yeah. But another thing this hits at, so what I mean in terms of like the impact specifically is that if office owners and office investors are looking for other places to invest, let's say demand is off 20% because they're all going in 4 days instead of 5, then they're going to look elsewhere. I think they're going to look maybe at real estate. And if they're looking for more stability, I think it's reasonable to expect that they're going to go at some point into the multifamily market, maybe be a slight pressure, a slightly more competitive, but
Well, it's interesting because, like a lot of I can see them going to multifamily just because it's an attractive asset class for all the reasons why we like it and we talk about it. But, I can also see some office folks because the operational piece of multifamily is what really differentiates multifamily from industrial or office or really retail. And so, either industrial or retail might be the more natural kind of step of hey, we've got leasing teams that lease office buildings. Well, leasing an office building, and it's B2B versus B2C.
Yeah.
We're leasing to other businesses instead of an office. We're leasing them a warehouse, or we're leasing a business, not an office, but a retail spot. That could make sense if their theses all line up.
Yeah.
But I think some people just see multifamily as just very attractive and a place they want to be.
Yeah.
Also,
that is interesting. I didn't really even think of. Yeah, if you want to change, if you are a office owner and operator, changing to multifamily is going to take a whole different skill set.
Yeah.
And you're dealing with whole different types of people. So that is a little bit of a barrier.
You get into the, the trash and toilets and, tenants and toilets and all that stuff, individuals dealing with, the drama that comes with it versus calling the, Joe, the office manager down at Amazon.
A lot less decision makers.
Yeah, exactly.
That's interesting. And another thing I just want to note quickly, and this is probably maybe like the thing that the more cliche, the more over referenced piece of this article is the idea of office to multifamily conversions. It's an exciting idea, and it's something that I always think about. It's like, how could you do it? But they reference it as a possibility for, let's just turn these office buildings into multifamily buildings. And I think that there's a problem with that. And I really think it is the shape of the office building. It is too wide. There needs to be at least one window in all the bedrooms in a building. And because of that requirement, you can't make an office building which has like a long, what do they call, like a floor plate or whatever.
Yeah.
They've got this huge area, and you can only build along the edges of it unless you want to core down the middle of that office building.
Yeah, make a courtyard.
That's what I'm imagining is a giant drill that just drills down there and make it a courtyard, and then you can build more apartments in there. But there's a reason why some of these skyscrapers that they're building in New York are super skinny, because that's easier to build apartments in than.
Well, I have heard from numerous developers that they are building for projects in under construction right now.
Yeah.
They've been changing plans to allow for the potential conversion for multifamily now. Like they're keeping it in mind of just some sort of modularity,
very
adaptability, and changing the floor plates and allowing for more windows.
Yeah.
And saying, okay, if we want, because they're literally saying we may be in the middle of building this development, and if they can get the zoning figured out, can we pivot to putting in multifamily in here instead of offices, because we don't know no one's renting office space, but people are still renting apartments right now.
That's interesting.
So there's a lot of that going on of the way, how are we looking at building in the future? But then you've got this question that a lot of people are asking, and there's been articles in the New York Times and all over the place about why don't we convert all these office buildings that are empty to apartments? And that's to your exact point, it's way easier said than done.
But you'll still get it, and I will still think about it. I'll still drive past a big empty building. It's such an enormous waste.
Do something with it.
Yeah.
And it all depends on how cheap you can get it for.
Yeah.
Because there's a price, and because at price, it's okay. Well, you have all the units on the outside, and you do have blank amenity spaces.
Yeah.
But you have to think about it's not just even the floor plan and but it's you have to have enough water, you have to have gas, you have to have enough electricity, and you have to have the mains feeding into the building, because people don't think about.
I don't have a shower in
exactly.
your office.
You're not using the water usage in an office building is nothing like an apartment building, and so there's a lot of utility. It's a lot of work.
Probably put weights in the walls differently or something. Oh man, that's a really good point.
You have to basically go back to gut everything and start from the beginning, and so some that can work if you get the basis right, but it's you have to get such a deal.
And that's so interesting. It's so interesting.
It is, but it's easier. People that aren't kind of in the middle of it, it's a very easy thing to say, snap your fingers, turn that into apartments, but it's quite a bit of a process. And there are people doing this. I've talked to some folks that are actively doing this, but even talking to them, they're like, it is incredibly difficult. It is incredibly expensive. 99.99% of projects just don't work.
Yeah.
But when you find one that does, it's great. It's like when the hotel multifamily conversions, those make more sense in a lot of ways, but still those don't always make sense.
I was thinking, and you may drive by this on the way to work, there are schools that turn into multifamily.
Yeah.
But
because most schoolrooms have windows.
Yeah.
Classrooms have windows.
And then I do want to reference just quickly, because I only mentioned it earlier before the show when we were covering the articles, is there is a dorm in California that was designed with as basically an office building where it had windowless rooms for people to live in, and it was reviewed by by a bunch of
Charles Munger designed it, isn't it?
I think
Charlie Munger designed it.
Well,
he gave the donation. He was like, I want this. Like, he had demanded that they use his plans.
Yeah, they had groups review it, kind of interested parties review it, and a lot of them called it a prison and said prison-like, very very apparent that maybe we do need windows. These rules for housing are probably there, yes, for safety and stuff, but I think people's preferences is to live in a place that gets some natural light.
Yeah, I think so. I think they're
just an idea.
Just think of,
they can work whatever. This is what else I was thinking too. Yeah, they could work in a coal mine. They could work in a windowless basement. But if we're gonna live there, let's give them a window.
You can develop it, but then people still would prefer some natural light to come in. And people have those like light bars.
Oh
you get your vitamin D. There's a decent amount of science. There's even science of our proximity to water is really important on how we feel.
Huh.
If there's a body of water, it doesn't necessarily have to be the ocean, but how many times you've gone to the ocean, gone to a lake, and you have a sense of it's endorphins or whatever some dopamine release.
It's like some E.O. Wilson stuff.
Yeah, I think having some light is good, unless you want people really upset.
Feel a little bit on see nature.
Yeah. Man, we've got a Yardi Matrix report.
Yes.
And there's a familiar city on the cover.
Oh, yes. That's what I said. It's, I think, probably my favorite regular multifamily report. It's got our hometown of Indianapolis beautifully gracing the cover. And I'll give a little teaser. I think we've got an interview with the head of research at Yardi coming up later this month. So, these come out every month, but this time there's a little bit extra reason to talk about it.
Do you think that they knew that interview was going to be coming up? So they
I sure hope so.
that really means that they are in the loop on the Gray Report. But Matt, we've been talking about since the big inception of the Gray Report, in a very biased way, because we're from Indianapolis. But we've been talking about why the Midwest is great, why Indy is great, why it's well positioned, and I think that we're getting some vindication right now, because we what we were saying was that it's incredibly recession resilient, and in times of economic volatility, we just can see continued linear growth. Now, you don't see some of the big pops in like a Phoenix or something like that of crazy rent growth, although we saw some pretty incredible rent growth in the suburbs of Indianapolis. But then when you have the drops in those markets, you don't see them in markets like Indianapolis or a Kansas City or a Cincinnati or a Columbus, Ohio. They're just much more resilient, and they can be mispriced because people they're Midwest flyover states. Why? As I was asked by one foreign investor from China, why would you ever? Are there jobs there? Do people work there? Why?
There's got to be a reason, and that's the thing too. Is there's other Miami and Orlando are ranked high in this list too.
Yeah,
and the reason why I can kind of wrap and again, it's our hometown. It's Indianapolis, is our hometown, but I can wrap my head around the story of Indianapolis's market success a little bit more easily than Miami and Orlando. But actually, and just to kind of skip ahead with if we're talking about these markets, and we'll get to the year-over-year rent growth, but I think that the individual market story really is actually. I dug into this. I was like, oh, this is really. I almost felt like I was nerding out for a little bit. It is topped by Indianapolis for year-over-year rent growth, but month-over-month rent growth has Indy in second place, trailing the rapidly recovering New York City apartment market. And part of Yardi's comments actually noted the strong prospects for gateway markets like New York City, and this is the slow return back to the office, and you actually really are definitely seeing it. For the year-over-year rent growth list, San Jose was in second place, followed by Kansas City and Miami. So there really is. if you look at just like the top 4 of these markets, Indianapolis, San Jose, Kansas City, Miami. What is really interesting about this is that these top apartment markets have had completely different trajectories in the past few years. For Indianapolis and Kansas City, it's a story of stability and consistency, not hyper growth, but still very strong growth that has continued long after other markets have slowed down. For San Jose, it's a story of like a sustained slowdown early in the pandemic and then eventually recovery. And San Jose is a higher priced housing market. And for a while, I was looking at San Jose in a similar way as San Francisco.
Well, but I think it's benefiting from San Francisco. It's cheaper than San Francisco.
Yeah.
People are moving there.
And that's why it was like, it's a little bit puzzling why. So San Jose's strong performance is a divergence from San Francisco, which San Francisco is 7th lowest rent growth in this list.
Yeah.
So you really, sometimes it's a market by market. Not all of the markets in that high price category are different. And I do think it's very interesting. It's probably that local effect of San Jose's relative affordability adjacent to a more affordable market. And so the other story beyond, so we've got the Midwest story, we've got this affordable version of an inaffordable living area, and then there is Miami, and Orlando actually is also highly ranked in here. There are these Sunbelt markets that have had crazy high rent growth during the pandemic and has crazy high rent growth now. Tampa actually has below average rent growth now, and they used to be right at the top with Miami. And Phoenix, which is another warm and sunny market that grew like crazy in the pandemic, is the lowest performing market here. At the very least, I think the continued presence of Miami and Orlando is among. The continued presence of Orlando and Miami among the highest performing multifamily markets is evidence that the Sun Belt is not a monolith. There are things going on in individual markets that is worth noting.
Yeah, I think Miami just is. If I could name one like capital of COVID exodus and baby boomers retiring and just people leaving New York in general, Miami would be it. I mean, because it's always been an attractive place. Miami's a good time. South Florida is just a good part of the country. You have all the tax advantages of being a resident in Florida. I think there was already going on. I mean, retirees living in Florida, that's nothing new. That's been going on for decades. But then, silver tsunami, all these baby boomers are retiring. They're all heading down to somewhere in Florida. And then New York, when everything was shut down, everyone who had any money and the means were like, screw this. I'm going to come back to New York. I love New York, but I want to be in the sunshine at least half of the year, and it's cheaper. I mean, that was the thing. Like I knew a couple buddies that moved down to Miami from New York, and they're like, yeah, I'm paying like $2,500 a month or $3,000 a month, but I was paying $5,000 or $6,000 in New York, and I've got a better place, and I go to the beach every like other day. And like, have you seen this place? It's beautiful. So to me, Miami makes sense as a story just on its own right, and not really connected to a regional trend, other than just the migration story of the Sun Belt, which is still going on. That's going to continue to happen. But what you see time and time after again is that there are these markets that just get overbuilt, and you see incredible demand, and the growth in Phoenix and Vegas, are the best examples of those, that they're at the top, and then they're either at the top or at the bottom. And right now they're at the bottom.
That's the number that I was looking for as a way to kind of comb through these markets is recent deliveries or future deliveries as a percentage of existing stock. And I'll get back. I'm going to really chase that one down, and I'll get back next week to find a reliable source on that. But that could help tell a different story. And that's actually something that is noted in the Real Page article that we're going to cover later. But supply is one thing. I think that your point about Miami is another. I think that story of COVID exodus creating almost like a sustained population.
Well, there's just increase. so much demand.
That's a bigger story.
And I think that Dallas would be the other example of that. Also in the Sun Belt, but still in the top 10. I mean, it's just after Orlando and Dallas are building a ton of apartments, but it's because there's a ton of jobs that are being created in Dallas. It defies,
and that's the thing is like there's a priority of these trends, and in these cases, in some cases, like I think especially Phoenix, the influx of apartments is really having a big impact. That's maybe one of the most or more major factors that is driving the performance. But in Miami, you could throw $1 million apartments. It's not going to affect it. It seems like.
I think people I think people got too comfortable in Phoenix a little bit. I think that they thought that there's just so much population growth and so much jobs, and there's a lot of great things about Phoenix, that it could sustain any kind of, or get over any kind of overbuilding. Yeah. And it'd be fine. They could just grow out of it. And they will eventually, but we are seeing that they are still in the, boom and bust category of a market, and not just, the powerhouse that I think some people thought that they were. Again, it's a great market. There's a lot of good things going for Phoenix. I'm not invested in Dallas. I'm not invested in Phoenix. I think Dallas is much more attractive from its stability, just because it has. I think it's much more diversified.
Oh, yeah.
In a lot of ways.
So just to kind of move on from the markets, I want to talk about a little bit of their overview, but really page 6 is where the juiciest part of this report is. I think it should be on. These paragraphs should be on page 1, but that's fine. I'll give you so I think we should stay on page 6, and then I'll just give you the headlines from the little summary of page 1.
Give it to us.
So the top line numbers for their national rent growth is 6.2 year over year rent growth. So basically, as the Yardi Matrix puts it, for 2022, we saw 6.2% rent growth. And December's monthly rent growth was actually negative 0.2. Occupancy was at 95.6, has been gradually trending downwards from a high of occupancy is at 95.6 and has been gradually trending downwards from a high of 96.2 in March of 2022. Part of Yardi's outlook for the apartment market is this trend of lower demand, and this trend is only kind of going to get more impactful as time goes on. There's not a huge dip from 95.6 to 90, or from 96.2 to 95.6, but still, the length of time, all these consecutive where it's just continually going downward and downward is fairly significant, and then now we can kind of get into their actual more bold statements. So the juiciest part really are these three bullet points, and they say the multifamily market is starting the new year with rapidly evolving conditions that are in some ways unprecedented. Multifamily's reaction to the rapid increase in interest rates and resulting weakening of the job market will be closely watched, and 2023 could see weaker household formation and demand. Meanwhile, transaction activity will be unaffected by uncertainty about values. And I just want to then read the very first paragraph that they have on the first full paragraph in this report. It says, in some ways, 2023 multifamily enters 2023 in a typical change of cycles. The market ran hot for 2 years, with national asking rents increasing 22% in 2021 and 2022. Rents will decelerate this year and usher in the next cycle. However, the lingering impact of COVID-19 and extraordinary financial engineering make this cycle unique. What they're basically saying is multifamily performance in 2023 will be studied for many years because it is at the intersection of multiple trends involving the economy, rents, demand, and the capital markets. This is what we were talking about earlier. Yeah. That's why I wanted to cover this whole paragraph, is that we are getting it's almost overdetermined, this uncertainty, and there's not just one thing that is making it hard to predict the future, but there's multiple things, which is why when they do say, and they say that for the first half of the year, we may see lower apartment demand, but then they do expect it to pick back up later in the year. I think that prediction in of itself, maybe there's some wiggle room there, depending on which of these these forces of uncertainty get resolved. By then we could see a more predictable increase in the economy or in apartment rents, maybe before June. I don't know.
I think it's a fascinating time to be alive, Matt. And I think we're going to be looking back on the last 18 months since COVID for the next decade or so and beyond. I think we're going to be looking at it and referencing it just like we did 9/11 or 2008 great financial crisis.
It is funny. I talked about how we're always looking back at 2008 and using that as context. No one ever looks at 2015. It's not every year. It's worth noting that that not every year is memorable as the past 3 years have been.
And I think it's interesting that getting just a little bit meta, but we when we started doing the Gray Report was, we weren't doing it before COVID. That would have been really great.
Yeah.
But it was pretty soon into COVID, pretty early into COVID. And at some point I would like to go back and at least watch clips or have ChatGPT do a summary of each episode. But it would be fun to actually go back and take clips of what we thought at that given moment in time.
Yeah.
And, will the archivist in, 100 years from now be watching the Gray Report and studying it? Who's to say they won't, Matt?
I know.
But I think it is interesting, the kind of just the last couple of years in the path and the changes.
Yeah.
And I mean, and just how quickly things have moved and how drastic they have been. And it's very difficult to get the perception in that moment in time.
Yeah. And you know what? One thing that covering this stuff every week has enabled me and hopefully the listeners to do is to determine which of these trends are moving any given market at one point, or which of the trends is moving the multifamily market at any given point.
Yeah.
We were talking about like Miami and how, the influx, maybe that's more of a priority trend than apartment supply, but to be able to prioritize what are the factors every month.
Yeah.
It's not always Jerome Powell.
No, it certainly has been a major element over the last couple of years.
Yeah.
And the Fed always is, but but just the amount of growth and
how all of these markets have followed their different paths. Like I said before, it's like they were all moved. They had different stories, and to see them all kind of coming at here right at this moment, maybe Miami will rocket to the top and keep going, and Indianapolis goes and kind of moderates a little bit, or maybe we're going to see Phoenix rise again to the top. But like just being able to track that is really interesting.
Phoenix has to rise.
Yeah. That's true. Oh, they're doing this because of the name.
Yeah.
Oh,
yeah.
that's great. I mean, technically, yes. Yeah. You don't.
Right.
Oh man, I'm gonna put that. That's going in the clip.
When you said you're like maybe Phoenix will rise, I'm like I
can't believe I haven't even
heard a story about that.
I should put that in the notes. Oh well.
Yeah, it's all good. Well, Matt, let's get into this Real Page article while we have the time and the viewers and listeners. Attention.
Carl Whitaker followed his great report last week on promising apartment markets for 2023, and now he's talking about markets that could struggle this year. Actually, a lot of his points we have covered in some ways, but just not about here's markets you got to worry about.
Yeah.
And also, I will give another teaser. He's probably also going to he's scheduled to appear on the Gray Report later this month too. So
it's exciting.
Get ready.
Big things happen on the Gray Report.
Yeah. So the three categories that he uses are big inventory growth markets where loss to lease has vanished, and some select lifestyle markets. Again, it's a lot of what we've been talking about. Some of the markets with huge inventory increases, I think, have huge populations that kind of offset the inventory growth. But there are some that'll just eat it right up.
Some of these percentage of inventories you were talking about earlier today are pretty astonishing.
Yeah.
For like Colorado Springs, I mean, that basically means for if they had 100 units, they're building 12 more. 12 more.
Yeah.
Which is. I mean, that's a lot. That's 11% of the entire inventory coming on new. And again, these are, A-class, nice, expensive apartments. That's a lot. 12% Huntsville, almost 11%. Sioux Falls, which is not a big market. Colorado Springs isn't that big either. Lakeland's at Florida, just under 10%. Boise, which has been blowing up, but it seems major declines recently in rents. They've already started correcting. Austin, I think there's not a big surprise there, but still 9%. I mean, this is anytime you're over 5% is a lot, and these are all over 6 to 12.
Yeah, and I'd like to know how many new supply was coming online in 2022 as well, because one thing about Phoenix is it's not only facing 7.2% of new supply coming in 2023, but it probably had a lot of supply in 2022, and it has low rent growth now. I don't think that the renters that have driven the lower rent growth in Phoenix were actually paying less and saying like, oh, I know a lot of new supply is coming online next year, so I'm not going to pay this much.
Yeah.
No. That was because of supply that had already come online.
Yeah, I mean, 28,000 units are coming online in Phoenix.
Again, it's just doing this so that it can rise again. And then another category that Carl Whitaker flags is markets where loss to lease has vanished. Loss to lease is a measurement of how much the difference is between a renewal is and a new lease. New leases are usually higher than renewals, so markets with a very high loss to lease mean that they've had a lot of recent high rent growth. When loss to lease is low, that means that the high rent growth is over.
Yeah.
And basically, you're not going to get that additional bump from slowly increasing the renewals. It's just like a less promising situation for apartment investors than if the loss to lease was high. I think that's kind of an effect of a lot of the different market forces that we were talking about, but it is something that you should track. And it actually, it's an expression of the history a little bit of a particular market and where it may be trending in the future.
Well, and especially since, a lot of the kind of growth that was, baked in was essentially absorbing, loss to lease.
Yeah.
And we see that loss to lease basically get eroded away, which basically means that, people would sign a couple leases for, call it $2,000 a month. Your old rents were $1,500. And so you've got this like $500 per unit loss to lease.
Yeah.
But now all of a sudden they aren't getting those $2,000 rents anymore. And they're now, going back down to, $1,600 or then $1,500. And it's like, and so that loss to lease, that gap where you were looking at saying, well, if we can get just all of our leases, we've only signed, 4 out of 100 leases at the $2,000. If we can just get all of our leases up to $2,000, we're doing great. But now that's no longer a possibility. There's no longer that potential it they can get. So yeah, it is interesting though, because like if you look at the loss to lease, it was so elevated, but then at the beginning of the pandemic it was below 2%, and maybe the norm is very, very low. Yes, because you were only getting 3% rent growth a year, and sometimes less, and then your nominal renewals were just a fraction of that.
Yeah, so like it's at around 4% now for the national average, maybe a little bit above, and that's still well above the historic average. So we've got some time to continue to absorb this, but it's going to go, and this may actually track pretty well with the CPI measurement of rent growth, if it is a kind of combination of both.
I think so.
Market and renewals. And then finally, Carl Whitaker notes that some of the Sunbelt or lifestyle markets may not do so well this year. And I think that does kind of track with the mild pullback that we've had from remote working. I think there are, like we mentioned, these Sunbelt markets like Miami and Orlando that are doing better. What Carl Whitaker says is he's look for markets with high in-migration and also strong job markets. Those are the factors that, I guess it's going to be a case-by-case basis.
But that's why Miami, people are going to there to work because the jobs are there. Yeah. I think it's people who are moving to, I don't know, maybe like Asheville, North Carolina or something like that, or maybe Boise, Idaho.
It's funny that you mentioned that because I think he says as nice as Asheville is, it's got some challenges ahead of it.
Yeah, building a lot of apartments and which Asheville's awesome town. I love Asheville, but it might be people all of a sudden like I'm gonna have to actually live in Charlotte or wherever. And
it shouldn't be. I think that there is this tug back to the workplace. Like some of the people that moved down to Miami from New York, maybe they're moving back now because they got to be in the office. The office is going to snap back. It's not, the thing that is going to persist is going to be a meaningful change. And it's not worth discounting that, but we've got a ways to go before we're finished settling at the whatever new normal is for office and working from home. I think that we still have some pullback to do.
Yeah, I think there's still people, working out of their vans. Yeah. But like a lot of the vans have been turned in, but not all of them. There's still some out there. But I think more and more, you can only do van life for so long.
Yeah, sadly.
Sadly. All right, Matt, any closing remarks, thoughts? This is a great collection of reports.
No, this is it just gets me more excited. I'm all of like the year-end recaps are over, and I was worried a little bit, like, oh, are we ever going to cover anything else?
Never again.
No. There's always more new stuff, so I'm excited to see what we got next week.
All right, Matt, so we can get some comments. And we haven't addressed the comments. Well, we have been addressing the comments on YouTube, but we said we'd feature them here, so we got to feature them here. So let's look at, who is this? This is the Right Time Horizon for Multifamily Investing, but this came out a month ago. Good episode. Buy YouTube links link in bio 5133.
Yeah, I don't think that guy's real.
I don't think he's real either, but he said new favorite YouTuber. So we can, it's no secret we are not buying views. We get, 100 or so. We got 6 thumbs up. That's nice.
But if bots want to come in, swarm us with likes and views,
say no. But this is real. Christian Rooney 4428. Great podcast. Thumbs up. And it looks like we've got a reply. So we really appreciate that. Thank you, Christian. Thanks. We said we appreciate it. And then here, why do multifamily investors? Where do multifamily investors go from here? We got Matt talking about something.
Engaged.
Buy YouTube views link in bio 2781.
Okay, so bots love us.
Let's hit that like button. Let's get some non-bot options here. Multifamily trends to watch in 2023. How do we get that contrast? That's a good shot.
Yeah.
Oh, that's from that camera. That's good. Macl, glad I found the show this year. I watch it every week, and it has been very valuable. Mac, we really appreciate the comment, and this one we actually will feature on the Lay podcast. All right, is the Fed looking for rent growth incorrectly? Probably. S.R. Benjamin Gilliam S9896. Why are you even reading the names? Good stuff. Thank you, S.R. etc. And then Christian, back again, you guys are awesome. Well, Christian, we appreciate you. You are also awesome. Is the Fed looking at rent growth incorrectly? Possibly. We just this is different. This is the same one. Okay, we'll edit that one out.
Yep. Here, can you click on? Yeah. Okay, cut one on here.
All right, interest rate realities in the multifamily market. Addison was in the hot seat. Let's see. User X5EZ1VP5R. Thanks for watching. Addison deserves the bonus, without a doubt. Great stuff again, you guys. Well, we appreciate your comment, not your complicated username, though.
Let's look for one that's a little more recent.
Let's see. Which markets are you looking at and have strong population growth? This isn't that recent. 1 month ago.
Okay.
Has strong population growth. Indianapolis, easy one.
Yeah.
Cincinnati.
That's right.
Maybe. Oh, this one had a lot of views, man. 176. See, that's not a lot of views, but for us, it sort of is. Mm-hmm. These reports bring such great value. Thank you, guys. Well, again, user X5EZ1VP5R. Thank you. Shorter username that I can pronounce would be great. Another rate hike. Good things can still happen. Good discussion, gents. Thanks for covering the different market data sources. That's what we love to do. Well, we appreciate it. Okay, one more, last one. Let's see if this is it. This is what we want. None of this. Oh, here we go. Okay, last one. This is one from last week, Matt. This is very recent. Mm-hmm. You can see
I'd love to know what they have to say.
On location. You really can't see the background. I wish you could. It was very nice and beautiful. You can kind of see the background. Anyway, as we continue to digress, Yuri Menzura, what are you talking about?
I can answer that.
Yeah.
This is the latest intelligence about multifamily real estate, the economy.
Yeah.
I think that's a simple answer.
I think so. I could definitely try to sum it up. Definitely multifamily real estate in the economy.
Yeah.
More or less.
I like it when I get the easy questions. Usually people say, what are you talking about? And I feel a little nervous, like maybe I'm being confusing, but no, this one's easy to answer, I think.
Yeah, that one we have a pretty straightforward response to, which we haven't replied to on YouTube. I'm sure we will, but it's pretty recently. But decent amount of views, man. 103 views so far on this video. Not doing bad.
Still, it's got legs. We got millions more to come.
Yeah, we got a lot more to come. So everyone, we appreciate you watching, listening. Leave a comment. We appreciate it. You see that we're reading it, responding eventually. And we'd love a subscribe or a like. Share with your friends. And if you'd like all this information in your mailbox, we're not going to send you anything physically yet, but at least in your email box, Gray Report. I mean, graycapitalllc.com/newsletter. You're going to get a lot more reports than just what we can cover on the Gray Report. Packed full of information. But also, we also run the #1 multifamily intelligence aggregator in the world. You go to grayreport.com. Get all your news information related to the multifamily industry, real estate, and the economy. It's at your fingertips 24/7, 365. Available anywhere in the world, Matt, that has the internet, which is not even in the world. They got it on the International Space Station. How often are they checking it? I don't know. I don't know if we know their IP address. Maybe we can check that.
Yeah.
I don't know.
We'll look on that.
I hope you've had a great week. Great time on the Gray Report. We'll catch you next week and see you on, I don't know, maybe something else.
All right.
Okay. Thanks, everybody.